So picture the most, you know, ruthless, ice-cold financial calculators on Wall Street.
Mm.
The kind of people who actually thrive in the absolute chaos of global market crashes.
Right, the ones just staring at walls of screens, extracting billions from the economy while the rest of the world is, like, just trying to hold on.
Exactly. And for the last 50 years, Paul Tudor Jones has been exactly that guy. I mean,
Yeah.
he has successfully navigated some of the most extreme volatility modern history has ever thrown at us.
He really is the quintessential market gladiator.
Which is why the whole premise of our deep dive today just stopped me in my tracks.
Yeah, it's a total pivot.
It really is.
Yeah.
Because when you ask this titan of Wall Street about his secret to ultimate success, like the core philosophy that keeps him sane in such an insane world, he doesn't point to some complex algorithm or, a brilliant economic theory.
Not at all.
No. He points to a simple, fleeting act of kindness from a total stranger at an outdoor vegetable market back in 1957.
It's just such a jarring contrast. I mean, you have a man who literally makes his living obsessing over the worst case scenarios of the global economy, right?
Yeah.
But then he anchors his entire worldview on, like, the absolute best of human nature.
Okay, let's unpack this. Our mission today is to pull from a massive stack of sources for you. We're looking at transcripts from an incredibly revealing recent interview he gave, alongside historical market data and economic research.
To really dissect the mind of Paul Tudor Jones.
Exactly. We're going to explore his very distinct philosophy on trading versus investing, his alarming warnings about what he calls the everything bubble, his existential fears about unchecked AI, and finally, how he views legacy in a world that might actually run out of traditional work.
And setting the stage for you listening, it's crucial to understand that this isn't just a biography of a billionaire, it's really a masterclass in risk management.
Oh, absolutely.
Because whether Jones is navigating a multi-billion-dollar silver squeeze in the 70s, or looking at the existential threat of AI today, his core skill is identifying what statisticians call tail events.
Those, extremely rare catastrophic situations.
Right, and finding the precise catalytic moments that trigger them.
So to really understand how Jones views the world today, we kind of have to start with how he views the world fundamentally. He looks through the lens of a trader, which is an entirely different species from an investor.
Oh, completely different DNA.
In our sources, he actually contrasts himself directly with Warren Buffett. He calls Buffett the OG of compound interest, pointing out that Buffett intuitively understood the math of compounding at age 9.
Which is wild.
Right, and Buffett's strategy is basically just find great companies, ride a long trend, believe in the American economy, and wait.
Which requires, an immense amount of patience and fortitude. I mean, to be an investor like Buffett, you have to be willing to stomach massive downturns.
Like 2008.
Exactly. When your portfolio might drop 50%, and you just have to sit on your hands. Jones freely admits he simply does not have that specific kind of nervous system.
He doesn't. He describes his own life not as a passenger on the American economic train, but as being a right guard in the NFL for 50 years.
Fighting in the mud.
Yeah, in the trenches,
Yeah.
every single day. And the proof is in the math. His fund has a minus 0.12 correlation with the S&P 500.
Which is fascinating.
It is. For anyone listening wondering what that means for a portfolio, if the stock market goes on a massive 10-year bull run, his fund doesn't just automatically float up with the tide.
Right. A negative correlation means his returns are entirely divorced from the broader market's natural upward drift.
Practically speaking, 100% of his returns are alpha. They come purely from his active, tactical decisions.
If we connect this to the bigger picture, we have to look at the why behind that intense active mindset. Why choose the trenches over the passenger seat?
It goes back to his formative years.
Yeah.
Right.
Yeah, on the commodity exchange floor in the late 70s, specifically the infamous bunker hunt silver squeeze.
Oh man, this story is wild, and it just perfectly illustrates the vulnerability of markets. So inflation is raging in the late 70s, and this Texas oil heir, Bunker Hunt, starts aggressively buying up silver.
Buying massive amounts.
Like 200 million ounces.
Yeah.
At an average price of around $3.12. And as inflation rips higher, silver rockets to $50 an ounce. Hunt is suddenly sitting on a fortune worth roughly $11 billion.
But then comes the mechanical failure that forever altered Jones's psychology.
What happened?
The commodity exchange officials, who were terrified by this extreme concentration of wealth and the chaos it was causing, simply stepped in and changed the rules of the game mid-play.
Just like that.
Just like that. They declared the silver market liquidation only.
We should probably break down the mechanics of that rule change, because if an exchange declares market liquidation only, It means you are legally prohibited from opening a new buy position,
Right, you can only close out existing positions.
which means you can only sell. By instantly outlawing new buyers, the exchange literally suffocated all demand mathematically.
And the floor completely fell out. I mean, the price of silver crashed from $50 to under $10 in a matter of weeks.
Wow.
Jones stood on the floor and watched the richest man in the market go virtually bankrupt almost overnight. Not because his economic thesis was wrong, mind you.
But because the arena itself turned against him.
Exactly. It perfectly validated the harsh lesson Jones's grandfather had taught him, which was, you're only worth what you can write a check for tomorrow.
It's all about hyperliquidity.
Absolutely.
You know, it makes me think, if Warren Buffett is a marathon runner, relying on the steady, predictable terrain of the road beneath him, Paul Tudor Jones is a gladiator who assumes the floor of the arena itself might collapse at any given second.
That is a great analogy.
But is this need for hyperliquidity essentially a trauma response from seeing fortunes evaporate in the 70s, or is it a calculated mathematical edge?
Well, the trauma definitely informed the math, but the math is what actually gives him the edge. In a highly volatile world, understanding the difference between structural growth, which is what investors look for, and exploiting human behavioral extremes, which is what traders do, is vital for your own risk tolerance.
Right.
Jones views trading like a brutal boxing match. You're jabbing, you're gathering information, you're testing the market's reflexes.
Most of the time, you're just trying to survive the round without taking a hit.
Yeah, but you are actively waiting for an opponent to make a mistake. You're waiting for an opening for a knockout blow.
And he found one of those openings with his massive trade on Bitcoin in 2020, treating it as an inflation hedge way before the rest of the market caught on.
Or in 2022, when he aggressively shorted 2-year Treasury notes.
Right, because the math dictated the Federal Reserve had to normalize rates, regardless of what the consensus was at the time.
He is constantly hunting for that catalytic moment. The whole strategy is to find an asset that is deeply undervalued and universally ignored, and then just wait for the specific trigger that will force the rest of the world to wake up and reprice it.
Like the Japanese yen example in our sources.
Yes. Japan has a massive $4.5 trillion net international investment position.
Let's clarify what that actually means for the listener. A net international investment position of that size means Japanese entities own $4.5 trillion more in foreign assets than foreigners own in Japanese assets.
Precisely. The wealth is there, the foundation is incredibly strong, but for a long time, the currency remained heavily undervalued. It was just dormant.
So a trader looks at that setup and says, I just need a catalyst to wake that money up.
And he points to the newly elected Japanese prime minister as that potential catalyst.
We should emphasize here that when Jones looks at political figures, whether we are talking about a new Japanese prime minister, Donald Trump, Ronald Reagan, or Joe Biden, he strips away all the partisanship.
Simply.
In his analytical framework, these leaders are simply pure economic variables. They are catalysts that can shift policy or national energy, forcing capital to suddenly reallocate and snap a market out of its complacency.
Right, so if he is constantly hunting for these singular catalysts that can break a market out of its normal state, we have to ask, what is the catalyst he is sweating over right now?
And that brings us to his warnings about the everything bubble. Jones looks at the mechanics of historical market crashes to understand our current fragility.
Yeah, like in 1987, the crash was driven entirely by the mechanics of portfolio insurance.
Automated computer selling that just fed on itself in a downward spiral.
Exactly. And in 2000, it was what he calls the easiest bear market, caused by a massive cascade of .com IPO unlocks.
Where corporate insiders were finally allowed to sell their shares, and it instantly flooded the market with excess supply.
But the threat he sees today is structural, and it is heavily tied to extreme leverage. Currently, the United States stock market capitalization sits at roughly 252% of the national GDP.
That is just a staggering number.
To put it in perspective, at the peak of the 1929 bubble, it was around 65%.
Wow.
And at the absolute height of the 2000 .com bubble, it was 170%.
So 252% is totally uncharted territory. And he lays out the brutal math of what a reversion to the historical mean would actually look like. If valuations drop back to their normal 30-year averages, That would translate to roughly a 35% decline in the stock market.
But because the market is so heavily leveraged against the actual physical economy, that 35% drop wouldn't just hurt portfolios.
No, it would wipe out the equivalent of 80 to 90% of the entire U.S. GDP.
Let's walk through the domino effect of how a disaster like that actually unfolds, because it is a negative self-reinforcing debt loop.
Yeah.
If the stock market drops 35%, the first domino is the wealth effect reversing.
People feel significantly poorer, so consumer spending just freezes.
Exactly. But the second domino is the government deficit. Roughly 10% of total U.S. tax revenues currently come directly from capital gains taxes. If the market drops, those capital gains vanish.
Here's where it gets really interesting, though. Meaning, the national deficit blows up even further. And when the deficit explodes, the government has to issue more debt, which smokes the bond market, drives up interest rates, and kills corporate borrowing.
It's a terrifying spiral.
It is. If I'm listening to this on my commute, hearing that a 35% market drop could effectively wipe out 80% of our GDP makes me want to pull over and bury my savings in the backyard.
Totally understandable.
I mean, how does Jones expect an everyday person to process this level of systemic risk, especially when you look at the vulnerability of the tech sector?
Well, the tech sector is where the math gets really concerning for him. It comes down to a looming supply and demand imbalance. For years, tech companies buying back their own stock acted as an invisible safety net.
It artificially kept demand high and reduced the supply of available shares.
Right. Historically, they buy back about 2 to 3% of their market cap every single year.
But right now, the biggest tech giants are pivoting.
Yeah.
They're pouring their massive cash flows into artificial intelligence capital expenditures.
Buying servers, data centers, specialized chips instead of their own stock.
So that historical safety net of demand is just disappearing. And at the exact same time, we're expecting 5 to 6% of total market cap to be added via new tech IPOs.
Right, so you have a massive influx in the supply of stock right at the exact moment the baseline demand from buybacks is drying up.
And processing all of these monumental structural risks, like the national debt, overvalued tech sectors, shifting monetary policy, it requires an incredibly intense schedule.
Jones is essentially analyzing global markets from 6.15 in the morning until 10:41 other at night.
But he notes that extracting a signal from the noise is infinitely harder today than it was in the 80s.
Oh, because of the sheer volume of data.
He says he receives upwards of 800,000 emails a day.
800,000.
How does any human brain process that without melting down?
He relies on a cognitive framework he learned decades ago, actually, working for his father's Memphis legal newspaper, Journalism 101.
It is such a brilliant filtering mechanism. In journalism, you are taught never to bury the lead. The conclusion must come first. The first paragraph has to contain the who, what, where, when, why, and how.
And he uses this concept like what data scientists call principal component analysis.
Which essentially means stripping away the thousands of flashing red and green lights on your screens, ignoring the background noise, and mathematically isolating the single heaviest variable that is actually driving the outcome.
Exactly. The lesson here isn't to succumb to financial panic. Panic is just an emotional reaction to noise. The takeaway is to practice what Jones calls exquisite execution.
Waiting for the right moment.
Yeah, as a trader, he's actively waiting for the moment of maximum pain or maximum elation to make his move. For you, the listener, the application is about rigorously prioritizing the information you allow into your brain.
You have to ruthlessly cut through the 800,000 emails of your own daily life to find the core data point that actually matters to your long-term goals.
That kind of ruthless filtering is exactly what he applies to his biggest fear, actually.
Something he considers the ultimate, untradeable tail risk. From the quantitative mechanics of the stock market, we have to transition to the existential risk of artificial intelligence.
It's a huge shift.
It is. Jones argues that great investors are, above all else, great risk managers. Yet, as a society, we are currently practicing zero risk management when it comes to AI.
He makes a fascinating distinction between the mindset of the tech industry and the mindset of the financial industry. Well, the tech world has always operated on the build, break, iterate model. You build software, you release it into the wild, it breaks, you fix the bugs, and you iterate.
Right.
And that exact model has driven human invention for centuries.
But Jones points out a terrifying reality. For the first time in human history, the break part of that model isn't just a crashed web browser. The break could cost hundreds of millions or even billions of lives.
Yes. Our sources detail a private conference he attended about 18 months ago with top AI modelers from the biggest companies on Earth.
And the consensus he heard behind closed doors was chilling. When asked how AI safety ultimately gets resolved, the general answer from the engineers themselves was that we'll likely only implement real safety measures after a massive tragedy occurs.
One where 50 to 100 million people die.
Which raises a massive question about global governance. Jones notes the complete lack of a public plebiscite. Like, there has been no democratic vote on the pace of this AI rollout.
He compares this vacuum of leadership to the invention of the nuclear bomb.
Oh, that's a good comparison.
Within 18 months of the bomb being dropped, society recognized the existential tail risk and formed the Atomic Energy Commission to regulate it globally.
Yet, years into the AI revolution, there is virtually no unified regulatory framework.
So his proposed solution is immediate and aggressive. He demands the mandatory watermarking of all AI-generated content.
He believes it should be a federal felony with mandatory jail time after 3 violations to pass off non-human content as authentically human.
He argues this is the absolute only way to stop the proliferation of deepfakes and restore a baseline of trust in society.
He also firmly rejects the transhumanist vision pushed by some tech elites. You know, the idea of a blended future where humans and machines merge via brain chips. He simply says, I'd vote no, and I think most humans would vote no.
But I mean, we have to analyze the feasibility of that watermarking demand.
Well, we absolutely do. Because if I am playing devil's advocate here, making watermarking a felony sounds great in a congressional hearing.
Yeah.
But is it actually enforceable on a global, decentralized internet?
It's tough.
Even Warren Buffett told Jones that regarding AI, the genie is out of the bottle. Isn't demanding a watermark at this stage like trying to mandate a speed limit on a hurricane? It just feels impossible.
What's fascinating here is it is incredibly daunting from a technological standpoint, but Jones argues it is the only baseline we have to prevent total societal erosion.
Like the nuclear bomb comparison again.
Exactly. In 1945, nobody thought global non-proliferation was enforceable either. The technology was out there. But the existential threat forced global powers to figure it out anyway.
That makes sense.
The tech innovators are conditioned to see unlimited upside and wave away the risks, while veteran traders like Jones are violently trained to obsess over the absolute worst-case scenario. He wants the listener to critically evaluate how they are integrating AI into their lives.
And to fiercely protect what he calls authentic humanity.
Right.
So if the tech world is threatening our baseline of humanity, where does a guy who spends his days analyzing these worst-case catastrophic scenarios find his own humanity? How does a person living in that high-stakes pressure cooker stay grounded and find true alpha in life?
It all circles back to that outdoor vegetable market in Memphis in 1957, the Curb Market story.
Right. So Jones is 2.5 years old, and he gets separated from his mother in this massive, crowded market. He is just utterly terror-stricken.
Poor kid.
Then an elderly black man finds him, calms him down, takes his hand, and patiently walks him up and down the aisles until they finally find his mother.
And when his mother tries to give the man a $5 reward, which is a significant amount of money in 1957, the man refuses.
He simply says he knew she would do the exact same thing for his child.
The mechanism of how that fleeting moment fundamentally shaped Jones's neurology is remarkable.
Because he never got the man's name right.
No. Jones and his mother added the unknown stranger to his nightly prayers. He prayed for this man every single night for the next 10 to 12 years.
Wow.
He calculates it was over 4,000 repetitions of gratitude.
4,000 reps. That physically wires a developing brain to look for the good in people. And we see the massive payoff decades later.
Yeah, 1986.
Jones is watching 60 Minutes and sees a segment on Eugene Lang. He was a businessman who returned to his old elementary school in Harlem and impulsively promised to pay the college tuition for every single kid in the graduating class who finished high school.
And Jones saw this and immediately thought, I can do that.
So he adopted classes in Bedford-Stuyvesant, which was one of the highest crime areas in New York at the time.
But this is where the trader's ruthless pragmatism meets philanthropy. He quickly learned through painful failures, kids dropping out, tragic deaths, that just throwing money at a systemic problem isn't enough.
You need pedagogy. You need a rigorous, measurable plan.
That realization led him to found the Robin Hood Foundation right after the 1987 stock market crash.
Bringing Wall Street's obsession with efficiency and metrics to poverty fighting.
And later, it led him to start the Excellence Charter School in Bed-Stuy. He applied the exact same demand for excellence that he requires on his trading floor to the educational environment of these young men.
Which is incredible. And This quest for significance is becoming even more urgent today, I think,
Oh, absolutely.
because Jones theorizes about the looming reality of a workless world driven by the very AI we just discussed. For generations, humans have derived a massive portion of their self-worth, identity, and significance from their labor.
So if AI permanently takes that away, where do we find meaning?
He believes human beings are infinitely adaptable. For him, significance beyond work comes from deep connections and active physical engagement. He plays intense competitive games of bridge and chess.
He does 45 minutes of hard cardio every single day to avoid what his 83-year-old doctor called fossilizing.
His doctor literally looked at him and said, "You retire, you die."
That's intense.
And my absolute favorite detail from our sources, he travels the country tracking meteorological patterns just to witness the exact intersection of weather and biology that creates peak spring and peak fall in different regions.
He describes finding that exact day when the colors and fragrances biologically peak as feeling the absolute most alive.
It is the ultimate exercise in being profoundly present in a world obsessed with the future.
Look at the duality here. You have a man who ruthlessly extracts alpha from the global economy, outmaneuvering the smartest algorithms on Earth, preparing for 80% GDP wipeouts. Yet, when asked for his ultimate life advice, he simply quotes his mother, "Kill them with kindness." He genuinely believes that the secret to a significant life is setting out to do just one intentional, unprompted act of kindness every single day.
If we bring this entire deep dive full circle, it is really a story about compounding. While Warren Buffett was compounding capital, those 4,000 reps of childhood prayer taught Paul Tudor Jones how to compound kindness.
He saw how one man's kindness to a terrified toddler created waves of betterment.
Waves that eventually built charter schools and funded massive anti-poverty foundations decades later. The challenge for you listening right now is to view your daily microscopic interactions not as throwaway moments, but as compounding assets.
What a journey this has been.
Truly. We started in the brutal hyperliquid arenas of global trading, exploring the mechanics of how to dodge the everything bubble by filtering out the noise and waiting for catalytic moments.
We stared down the existential, unchecked tail risks of AI.
And we ended up finding grounding in philanthropy, the pursuit of peak spring, and the staggering return on investment of a simple act of kindness.
I want to leave you with a final thought to mull over. Earlier, we debated how the tech world's build, break, iterate model is incredibly dangerous when applied to artificial intelligence. But maybe that is exactly the model we need to apply to our own personal lives.
I will like that.
If you deliberately break your normal, self-absorbed routine today by injecting just one unprompted, intentional act of kindness into the world, what new, more significant version of yourself and your community might you iterate into tomorrow?
That's the real catalytic moment right there. Thank you for joining us as we unpack these sources today. Go out there, find your peak spring, and we'll catch you next time.